Okay. I just restarted the recording, so I'll make sure the beginning of this is good from our start of our presentation, how to profit using the cloud and options to swing trade market sectors. So I just started over the recording since we had a little glitch there and we lost the screen which we were actually viewing. So these are the symbols we actually trade, nothing else. Reasons number one, the pricing of these ETFs for one contract can range anywhere from $70 to $2,000 for one contract. That gives everyone an opportunity and something that they can trade. So if you have a smaller account, you can trade some of the ETFs that have smaller or lower priced options. If you have a bigger account, then you can trade some of the bigger boys like the SPY or QQQ or DIA. Those cost more. They give great results, but they do cost more per contract. So, and there's everything in between. So there's something here for everyone. Also, with the diversity, you get people tend to like to trade different things. Some people really like to trade energy. Some people like to trade the major indices. Some people love to trade gold. If they love to trade gold, they can trade gold. Some people like to trade financials. They can trade XLF. So different people like to trade different things. So it gives people a chance to specialize in certain sectors or trade everything if they want. And so there's a lot of variety here that accommodates everyone and their interests and what they really want to do. And what we do is we provide the win-loss stats for each of the strategies. So we have strategies that buy market bottoms. We have strategies that short market tops. We have strategies that get you long as markets are going up and they get you long as a trend has been established. We have strategies that get you short as markets are going down. And we have strategies that get you short as a short has been well established. So we try to trade moves up and down through the full range. So basically, we're making money when the markets go up, and we're making money when markets are going down. And we have very few false signals when the markets are chopping sideways. So, and that's with options. So that's why we have this great variety and diversity of things to trade. And the strategies we use are very powerful directional trading strategies. They're not to be traded with spreads. They're directional strategies. And with all my strategies, I've actually gave them to people who I know and trust to be extremely good spread traders because I've done presentations for options groups. People within those groups are really, really good spread traders. So I said, if you can find a way to trade these strategies in a better way than just buying calls and puts, here are all the rules. Find me a better way. And every single one of them came back and said, we could not find a way to spread trade these, just buy calls and puts. And that's the thing you got to understand. There's some strategies, especially with options, you don't do spreads. Something that's meant to be directional trades, you buy the call, you buy the put. And as long as you can do that intelligently, rules based, and you have some history and criteria for purchasing the options, pricing wise, and everything, you don't have to worry that much about time decay and that type of thing with the option decaying in value, that type. So, and since we do ETFs, the implied volatility is much lower than with stocks. With stocks, you have issues with implied volatility crush, that type of thing, but we don't have those same issues with the ETF. So buying just calls and puts works for us very, very well, and we've been doing this a very long time now, so we know it works. All right, so let's scroll down a little bit. Some of you are familiar with Ichimoku Cloud. If you're not, it was created in Japan a long time ago, many, many decades ago. And I will switch over to the live charts in a second. So I'm going to do another show the handouts are in the chat window. Look there. If you have any questions, please write in the chat window or just unmute and ask it along the way. Any questions you want. So we're going to go through the Ichimoku Cloud and we're going to go through one strategy in particular. It's a Kumo buy. And in the handout, what I did was I picked one symbol, which was XLE, the energy sector, and we put down every trade over the last 20, about 20 something years, every valid trade. And it's at overall 88% wins, 94% wins on the long side, 82% wins on the short side. Much better results on the long side, okay? But this is over the last 20 something years. So this is something you can use as a reference if you're looking at it later on to find the trades, or if you're developing something on your own, use this as a reference to make sure you're looking at the same thing we're looking at. All right, now let's go ahead and I'm going to switch over to the chart. Now I'm going to change the share. Okay. All right. You should be looking at the Thinkorswim chart right now, and I'm looking at XLE. So let's go take a look at what we have here. The Ichimoku cloud. This colorized version, these patterns here are the area between two sets of moving averages. That is what gives it the look and feel of the cloud, okay? So this bottom portion, this is a bearish cloud, this is a bullish cloud. This line here, when it's above the bullish cloud, this is span A, Chiku span A. Bullish cloud, this is span A is the upside, and span B is on the downside. When it's in the bearish, span A is on the downside. It just crosses. Good, get even better visual. Here is span A, and when it crosses above span B, it's bullish. When span A crosses again below span B, it's now bearish. And these two lines cross up and down consistently. All right. Bullish cloud, bearish cloud. Bullish, okay. That's span A, span B. It's all you need to know for this presentation as far as that goes. Okay. Span A and span B. Now, this yellow line is a Chiku. The Chiku is 26 days behind. It always lags by 26 days. So this value is you're seeing on the chart is here is today's closing price of 87.36. Take a little data box. So here's a data box. Okay. And 27.36 is the closing price. Excuse me, 87.36 closing price. When I go back here, I'm gonna change the color so you can actually read it. You can't read the yellow dealy here. So I'm going to change that slightly. So I'm going to change the Chiku color to a different color so you can read it. Let's make it that color. Apply. Okay. So now the closing price again is 87.36. And the closing price of the Chiku 26 days ago, 87.36. Take a look at the data box. Here's the data box here. 87.36. And it is above the cloud. And this value is above the cloud. Here is the top of the cloud, and this value is above the cloud, okay? So those are the things you're going to be looking for. Now, let's take a look at the strategy now. How do we know when we have a trade signal? What we look for, I said, one of our oldest strategies. No one will ever tell you this unless someone shows you because it's not blatantly obvious. We're looking for price to close above the cloud. Here, price closes above the cloud, okay? In August, price closed above the cloud. Now, 26 days ago, the Chiku had to be above the cloud. So here's price closes above the cloud. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. 26 days ago, the Chiku was above the cloud. That is the confirmation. Here is our setup. Price closes above the cloud. 26 days ago, I think it was this one, the Chiku had to be above the cloud. Okay? 26 days ago, the Chiku was above the cloud. Again, one, two, right over here, one of these days, the Chiku was, everything here is above the cloud, the Chiku-wise, Chiku's above the cloud. This is the setup. That's our trigger confirmation. Okay? That's what we're looking for. In between, we want at least four previous, so before this closed above the cloud, we want to have several of these days closing below the upper Chiku of the cloud. Okay, and when I go through this in detail in coaching sessions, we get very specific how many days, that type of thing. It has to close below because it's a very specific number. So we go through that in coaching sessions. It's not just every time close above. No, we don't do that. Or it gets chopped up. Again, close above the cloud. Certain number of days closing below the upper Chiku of the cloud. And 26 days ago, the Chiku had to be above the cloud. That's it. That's it. When that happens, we know because we have the stats on 20 something ETFs and all of them, all the trades going back a couple of decades. We know on XLE, this is the energy sector, that it is 88, it is 94% wins on the long side. A win is defined when the first profit target is reached before expiration. And time is usually about 2 months worth of time on the option. Our target is based on the ATR. So if you take a look at the data box, the ATR on this day was $1.32. $1.32 on average is how much this ETF is moving every 5 days. So our targets are based on volatility, not option volatility. We're not doing any option analysis. We're doing analysis of the underlying product of the ETF. And then we're using options to trade the ETF. But we're intelligently choosing the option at the right price, at the right strike, and at the right delta. Okay? So if this ATR is $1.32, we add $1.32 onto the open price the very next day, and that is going to be our first profit target. So if the market opened at 87.92, someone grab a calculator. Someone open up a calculator on their computer somewhere. What is $1.32 added to 87.92? So 87.92 plus 132 is what? Someone type it in the chat window for me. 87.92 plus 132. Someone type it in the chat window. 87.92 plus 132. 87.92 plus 132. 89.24. Thank you, Connie. All right. So we would be entering the trade, basically buying call options at or below the open price the next day. The next day it opened at 87.92. We're always buying an in the money option. Always, always, always buying an in the money option. Let's say we buy an 87 strike option. Okay. Connie said the number is, the first target is 89.24. That would be $1.32, the ATR, which shows the volatility of this product on this day. We had our trade signal added to the open price the next day. And that day, the high was 88.48, so it didn't reach the first target. This day, 2 days later, the high was 89.54. So it took 2 days for the trade to hit the first target. Actually, 3 days. One, two. On the third day, the target was reached. Okay. You could have gotten into this trade anytime that in the next 2 days because we have to enter at or below the open price the next day. So some people really rush to get in that first minute of when the market's open. That's great and good. You won't get a great fill price, but you're in a trade. But we all have lives and stuff to do. So if you got in the next day, the entry price was supposed to be 87.92. But let's say you got in the next day, the low is 87.41. You could have gotten in up to 50 cents lower, which means now your target is 50 cents bigger. So instead of $1.32 target, you could have had $1.80 something target by getting in at a lower price. So you just entry is just at the open price or lower. So as long as we're at the open price or lower and the first target hasn't been reached, this trade is still in play. And that can translate to a difference of 10 to 20 something percent return just by getting in at a much better price. But a move like this in 2 or 3 days, we're looking at a 20 to 30 something percent return. And if you get in at a better price than expected, that could be a 30 to 40 something percent return on your money in a couple of days just by getting in at a better price. Okay. Um, this is how we trade. We don't sit in front of a computer all day long. Not that we haven't done that, but that's the stuff we did when we were starting out trading. That's because we didn't know any better. That's what everyone does. They start out day trading. They think they're supposed to sit in front of a computer all day long. No, that's just what people do when they're starting out trading because they don't know any better. That's all they hear about day trade. Let's day you day trade, you day. No, it's you evolve like any other business. You evolve. You want to eventually work less and make more. So what we found out, myself and Becky, is that the same amount of money we were making or losing spending 3, 4 hours a day or more sitting in front of a computer day trading was the same amount of money you can make or lose sitting in front of a computer a few minutes a day swing trading. You actually need less capital to swing trade than to day trade. Because day trading, you're looking for little tiny moves. Swing trading, we're looking for much bigger moves. So you need less capital to get the same results as if you were day trading. So it worked much better for us. But all that stuff didn't really come to us automatically until we started hanging out with people who trade their own real money as opposed to just doing like trading workshops um, or educational organizations, basically. When we found we used to go to the Traders Expo in Las Vegas, we travel literally all around the country to learn from different people who trade their own real capital. And we learn strategies like this and how they actually trade their own real money because they've got to a point themselves, they don't want to sit in front of a computer all day long. Let the trades do the work, not you sitting there working for every penny you make. You put the trades on and walk away. So this takes me a couple minutes a day to do this, and then I walk away. You have to put the trade on at some point in time during market hours, but the analysis is done when the market's closed. So you know what you're going to be doing the next day or the next week. If I scroll back, I can scroll back to any place I want and stop. I end up stopping the same plot. There. Okay. I'm going to go to the long side. Okay. Close above the Kumo. Multiple closes below the upper Chiku. And I count back 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. Hey, the Chiku is inside of the cloud. Not valid. This one would not be valid because the Chiku was inside the cloud. If the Chiku was above the cloud, then I'd have a valid trade. And I'm going to have different trades valid here because we don't just trade one strategy, we trade multiple strategies. So we will have a different strategy valid to catch this move, just not this particular one. Okay, let's scroll back. Boom. Close above. We got some multiple closes below. That's what we look for. We got a close above, multiple closes below. One, two, three, four. So that's the visual we're always looking for. This one, we only had one close inside the cloud and close above. Not enough. We need multiple closes in at or below the top Chiku. Close above. 26 days ago, we're definitely not above the cloud with the Chiku. Close above, not above the cloud with the Chiku. We don't get a lot of fake out signals. All this bearish stuff, we got no fake out signals. Close above, big bearish move. They might have caught a move there, but no fake out signal. Let's take a look for the, okay, what year am I in here now? So I'll go to the listing, 9/23/22. In 2019, we have 10/1. Let's see. We go through 10/1/19. Get over here. Okay. So let's take a look on the short side. 10/1/19. It's on the listing you have in the handout. 10/1/19. Close below. You go back 26 days. It's the opposite of the flip of the long side. Close below. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. 26 days ago, the Chiku is below the cloud. That's the confirmation. Close below the cloud, several days closing above span A, the lower level of the cloud, and the first target is going to be 1 ATR. That gets hit within 1 or 2 days. You're entering at or above the open price the next day. Targets hit within 1 or 2 days. Just the opposite of the buy side. Is it that simple? Yes, it is. A couple of years ago, to my surprise, I found out from someone who had went to one of my workshops a year earlier, and they said what I presented in the workshop was the only thing they knew how to trade. So that's all they ever traded, that one strategy, and they made money consistently because that's all they knew. And that keyword consistently is what works really, really well. Consistently. If you're consistent with whatever you do and it's something that has an established track record, as long as you're consistent with it, you will make money. If you're looking to get rich, For people, I've had people tell me, well, I have $100,000 account, and realistically, they expect to make a $500,000 a year from a $100,000 account. Sorry, that's a fantasy world. The only way you do that is if you basically gamble your whole account, take big risk, and get lucky. Okay, that's how you can do that. Is it doable? Yes, but you will just getting lucky and gambling. So that's not how you make money. You make money by doing things in a business-like manner, and planning your trades out, and good things will happen for you. Let's take a look at another trade here. This is the beginning of the year. Long trade, 117.25. Let's see, we have a long there. That one was a loss. 117, that was a losing trade. So this was a loss here. So this one was a losing trade. We had a buy signal here. It never went up, so that one goes down as one of the few losses. This on the spreadsheet that you have in the handout. So that one would be a valid loss. Let's go back a little ways to take another trade. Like I said, we have multiple ETFs, so there's always something to trade. So even if you don't see one on this listing for this ETF, there are many other ETFs which we're trading. So that's why you have multiple opportunities. This is 113, close above the Kumo. That's all we're looking for. The close above and multiple closes within or at or below the upper level. You go back 26 days. It's obviously that the Chiku is above the cloud. Don't even have to count it. One ATR is $1.96 added to the open, which is 90.16. That's 90, 91, 92, 92 something. It went as high as 93 something. So this target is hit within 2 weeks. Within 2 weeks, this target is hit. Okay. Usually we have about 2 months worth of time on the option, and we have rules for that also on option pricing, because you just can't just can't go buy a call option randomly and think you're going to make money because you pay too much. You automatically have a loss before without even knowing it because of time decay and that type of thing, volatility issues. As markets go up, volatility drops out, pricing drops also. So it is a race between we make money from the movement, from the directional movement, but over time, as the market's going up, volatility drops out, the price drops also. So our magnitude of our target has to be big enough to overcome the negatives that are created from time. Time is not in our favor of buying calls and puts. So how big a move we expect has to be big enough to overcome all the negatives. So that's the benefit of these type of trades. It's very reliable trading. It works quite well. It's a strategy that you can put into use right away. And it is something that you can add to whatever you do. If you just added this one strategy and did nothing else, you'd have a very good um, trading career trading ETFs, just doing this and nothing else. As long as you have a nice grouping of ETFs which you're using for the strategy. Like I said, when I did a presentation, I gave it to one person. They just traded one strategy only because they didn't know anything else, and it worked for them because they were consistent. If you know something is 85% wins and you're risking $800 in every trade, as long as you're controlling how much you can lose, the numbers just work themselves out. You're risking 2,000 in every trade, then you risk 2,000 on every trade, approximately. And the numbers, once again, work themselves out. You don't know exactly how much you're going to make on a trade because there's options. It could be anything. It could be anywhere from a negative 10% return and anywhere up to a 30, 40, 50% return. It just depends. So, like I said, consistency is key. And this is how we make money trading options. Just be consistent, be consistent, be consistent. This is one strategy for the people who are coaching clients. If you don't already have this strategy, just let me know. I'll send it to you. And if you are this is no longer part of our main grouping. only because we have the Donchians now. Donchians give you more trades, but we still have people who trade these old Ichimoku strategies that still work. So we do maintain the stats on them for anyone who wants to use them. But just use this as an example. If we got in the next day, we know the first target is 92 something, hit over here. But after you get in the trade, the market dropped. So you got in, it opened at 90.16 as the entry price, but it dropped as low as 87.79. So let's say instead of 90.16, you got in 2 points lower at 88. Let's say you didn't get in the first day. You didn't get in the first day because you're busy, you have a life, you have things going on. You didn't get in the second day, you were traveling, you had family things, you go anything. You weren't feeling well. You have work. You just couldn't get to it. The next day you were looking at what trades were valid that you might have missed and you saw, hey, there was a trade valid this day. I'm not in it. Can I still get into it? Was the first target reached? It went as high as 91.50. Nope, the first target was not reached. So this is still a good trade. But now I'm getting in 2 points lower than expected. So now instead of my target being $1.96, my target is now $3.96 because I'm getting in 2 points better than expected. My first target is still up here, but now I'm getting in 2 points lower than expected. So now my target is no longer the ATR 190 of 196. It's now 2 points on added to that because I'm getting in 2 points lower. It's now 296. Now my first target profit will go anywhere from 10 to 15 to 20%, which is what I would normally expect. Now it's going to be in the 60 to 70 something percent return neighborhood, but just by getting it a couple of points lower. Okay? A few points lower than expected can change your percent return significantly. Significantly. And then we can also trail stops to increase more profits. If you want to do a little bit more work to get a little bit more, that's okay too. But this is how you can really magnify your profits on trades is by getting in at a better price than expected. Because you get into this trade valid here, you can get into it here, 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 here. One, you had 1, 2, 3, 4, 5, 6, 7 days to get into this trade. For 7 days, the first target was not reached, and the price was lower than the entry price, which is the open price the next day. So we had 7 days to get into this trade. Some people want to rush and get in over here. That's okay too. You get out of the way, don't have to worry about it. They put the exit order in and walk away. And there's nothing wrong with that. But not everyone has a life that can, and lifestyle and timing and everything that can do this. So I know some people have other responsibilities in the morning, or they get up later, or whatever. They have family stuff. They have to go to work, and they get their trades in when they can get their trades in. And if you get your trades in 4 days later, it's like, okay, you're still going to be getting in a much better than expected price. So now your profit is going to be way higher than expected. All right. So this is how we take a simple trade that'll give us a 15, 20 something percent return and turn it into a trade that will give us a 40, 50, 70% return just by getting in a better price than expected by being patient or by luck of not getting in right away. So the more patient you are, you will miss some trades, but the ones where that pulls back first a little bit, those are the ones that one of these trades getting in down here is the equivalent of 2 or 3 trades if you'd gotten in right at the open. Okay. But this is a strategy that you have seen some of the other Ichimoku, some of the other strategies I've shown before in presentations, like the Donchian. That is just one strategy, but we trade a grouping of 6 primary strategies, 2 secondary strategies, squeeze play sell and squeeze play buy. We use those only for SPY, DIA, and QQQ. And this is one of our legacy strategies that still works just great. We maintain it. We have several people that still trade it. I trade it on SPY, DIA, and QQQ. But it's a great strategy. It still works extremely well. It's never failed us. Um, the only reason not on the primary group is because the Donchins he give us more trades. But this is still working well. I know people who still trade it, and it's very reliable. And we have a Senku strategy also, which I'm not going over today, but it also works extremely well. For today, I'm just going to be going over this strategy because as we're getting into the end of the year, um, markets are going to pull back at some point in time, and then we're going to see our next buying opportunity. So, do we have any questions on this right now, on this strategy? Okay, so I'll go back to the handout a little bit. Like I said, if you don't already have the strategy, email me if you're one of my coaching clients, and I will send it to you. But I think most of you have it. I know some of you wanted to trade it when we went over it previously. So I use XLE as an example to put all the valid trades on over the last 20 years. Don't just trade, don't just go over and trade stuff randomly without doing your own back test. When we look at all the numbers, we know we have a much better advantage trading this strategy on the long side. So this is what we have for all the different strategies. We have all the stats long and all the stats short. Generally with ETFs, we don't trade anything less than 84%. There's a margin of error, that type of thing. But definitively better results on the long side. So when we have an Ichimoku Kumo trade on XLE valid on a long or valid on a short, we would usually say we're going to pass on a short trade because the stats are too low. But if we see a long trade valid, then that's a definite 94% wins. Take the trade, place the order. And just for a little history, XLE was the first ETF that I really loved trading. Cool. Became one of my favorites probably back in 2006 is when I started trading XLE, and it became just my favorite. It's always been an XLE Energy and the QQQs. The Qs, NASDAQ, and XLE are my two favorite ETFs to trade. They've always been good to me, and they give great results. And the options on the XLE are reasonably priced, so you don't. So even if you have a smaller account, a mid-size account, you can actually afford to trade XLE. Like I said, some ETFs are really expensive. XLE is that medium-priced ETF that you can afford to actually trade, and you get great results with this type of strategy. But if you're going to be doing this review on your own, making up your own list of ETFs, make sure you do this. Go through a history of trades, and I'll tell anyone, no matter what you want to trade, make sure that during 2008, 2007, 8, and 9, whatever you're trading works, whatever you're trading would actually work for you. That's when the market got destroyed and dropped 50% over a period of months. So if you take a look at here from mid 2007 to 2009, we have one loss in March of 2007, and that's it. So whatever you're trading, make sure that your strategy works from 2007 through 2009, both long and short. Um, if it doesn't work during that time, you have a problem. You have a bad strategy, not well thought out. I've had people tell me, well, that could never happen again. And so you lost all your money during that last time, right? Yeah, but that could never happen again. That's ridiculous type thinking. Sorry. Um, how long will it take you to recover all the money you lost the last time it happened? And the next time it happened again, you make excuses like that. That doesn't make any sense. It always happens again. Um, this even wiped out brokerages. It wiped out major Wall Street companies because it always happens again. They probably said the same thing after the crash in '87. It'll never happen again. It always happens again. That happened in 2001. They probably said the same thing. It never happened. It happened again. Okay, it always happens again. Something comes up, the market pulls back, and markets and companies are really designed to run when markets are going up. When markets are going down, all those big firms, they don't really, their money has to be in the market. And everything goes down. But we capitalize on that as traders. We have the ability to capitalize on the shorts and the longs. So that's where we have the big advantage. And that's why we trade our strategies. If you've seen it or not, but it's also a copy exists on the website. I'll show you that in a second also. Let's share. I'm going to change the switch. Okay. This is our trades for this year. I'll send it out to some of the coaching clients and some people who are on our list. But this is what our trades look like for this year so far. These are just, once again, the sectors we trade. These are all the different strategies which we trade. Doesn't matter if the market's long or market's short. It's a matter of consistency. If you didn't make money this year trading our strategies, you got to contact me soon because you're doing something wrong. And I've talked to people who had trouble making money. And what I found out they did, they chose a couple of trades, like two trades, um, and then those two trades happen to be one of the few losing trades we've had, but they didn't place any other trades. So going back, this was a ridiculously great year to make money trading our strategies. This is going back to June. Massive number of winning trades. For the year, what's the summary? 89% wins overall, 85% on the long side, 89% wins on the short side. Last time we had several losses months ago. So I guess it was someone who had told me that they took a trade like back here and they had a loss, and then another one that had a loss. And then, well, then I asked them, okay, of all the other 80 wins we've had, how many trades did you place? And it was none. Well, you can't just place two trades who happen to be just by chance. You happen to, of all the winning trades, you picked the two losing ones. That happens, by the way. And then you watch them become losses, and you did not place any other trades to offset because you need offsetting wins. It doesn't, this is the numbers. There's numbers involved. You got to have enough wins to offset your losses. So you have to keep placing trades. So we had a couple losses early on in the year. And then since then, the last, since April, has just been massive numbers of wins. Massive, massive numbers of wins. And if you just one solid month of trading and negates a whole bunch of losses, but you have to keep trading. What I always say with everyone, every time, in 12 months of trading, you will have 2 to 3 losing months. Absolutely guaranteed you will have 2 to 3 losing months. That will be negated by 2 to 3 winning months. Just wipe the slate clean. 2 3 losing months, 2 to 3 winning months. The remaining 6 to 8 months of the year will be your profitable months, and that's your profits for the year. So you have to always keep trading. It sounds easy to say it, but when you're in the heat of the moment taking losses, it's hard. But it's true. This is what you got to do. You got a system. So when we're trading our strategies, our system, our method, our ways, that's exactly what you've got to do. You've got to keep trading. You get a couple of losses, you keep trading. And I will go over your trades with you every month just to make sure things are going right. Make sure your losses are valid losses. Make sure you're doing your trade management correctly. And as long as you're doing that basic stuff correctly, if a loss happens, great, a loss happens. Was it a valid loss? Great. If it was a loss that shouldn't have been a loss, let's figure out why it was a loss and let's not do that again. So that's what I do with coaching clients one-on-one. I only do one-on-one, no group deals, because everyone's different. I might have to explain one thing to someone 5 different ways for them to understand it, and some people what I think is simple for some people might find it complicated and vice versa. So I have to adapt to each person and find out how to communicate best with them to get the point across for certain things. That's why I like the one-on-one approach. But consistency for trading, because if you're trading early on, you got a couple of wins, couple of losses, yeah, it's all going okay. You got a month where you got a couple of losses all in a row. Yeah, big deal. Those are your two losing months for the year. That's it. Maybe a third potentially, but then boom, win after win after win after win. And that's what I always talk about. You will have 2 to 3 losing months every year, negated by 2 to 3 winning months. Keep trading the rest of the months. That's your profits for the year. That's how we make money, just by being consistent and following the plan, follow the rules, do it the way I tell you to do it. Is it okay to speculate once in a while? Yes, it's okay to speculate once in a while with a small percentage of your profits that you made from trading the way we showed you how to trade. Let's say you made $8,000 in the last few months trading the way we showed you how to trade, and you want to spend a little bit, a percentage of that profit speculating on something, have at it. Take a percentage of your profits and speculate. Meaning, do whatever you want with it, but you don't take a big risk. You're only risking a small percentage. You made 8 grand, maybe you want to speculate, but no risk more than 5 or 10% of your profits. You want to just play a little bit, whatever it might be. But that's how you speculate. You first and foremost, you follow the plan, make money the way it's supposed to make money, the way we show you, do it the way we tell you to do it. Then you make more consistent money. Then from your profits, take a small percentage of your profits, and then you speculate, play. You heard about something, you want to try something out. No, nothing wrong with that. Have fun with it, but don't just. I know people who've literally risked their whole account trying to speculate, paid a big price for that. Then they contact me usually after they do something like that. I've had people contacting me saying they did something really, really dumb and they are about to lose $100,000. And then when you start talking to them, they admit it was really a whole lot more than 100,000. Help me, help me, help me. It was that type of thing. So there are smart ways to speculate and not so smart ways to speculate. Anyway, I'm going to go back to the handout now. Got a question here. This is from Bill Graham. Do you still place your profit targets to expiration cycles out? So as you see, you have the trading plan for all the Donchian strategies, Bill. So for this one, it's 2 expiration cycles. For the for the Ichimokus, yes, it's 2 expiration cycles. You have the Donchian stats for the 1 expiration cycle, which are usually pretty good. However, those are business decisions. So the one expiration, which is basically 1 month, the stats are usually not as good as 2 months out, but for this strategy, it's 2 months out. Definitely 2 months out or 2 cycles out. Don't do one cycle for this particular strategy. Do two, but it works extremely well. I usually don't send this one out in the email I send each night because not everyone is doing it, but the people who are trading the Ichimoku, Kumo, and Senku, um, it's up to them to basically track the trades. I give them the updated trade plans and stuff and stats. It's up to them to track the trades if it's something, because we do this as a added on top of everything else. So, but this is what we train you how to do. All these different strategies is what we train you. 6 primary strategies and 2 supplementary strategies that are just for, like this one is squeeze play. This is just for the Dow, Nasdaq, and S&P. So we have squeeze play long and squeeze play short for the major indices only. The other ETFs are for every sector. All right, I'm going to switch back to the handout. So now you know what we do. This is represents what we do, the trades. And we send this out every month so people can compare their results with what we are seeing. And if your trade results are different than what you saw here, if we show a long win and you show a loss, then there's a big disconnect. Let's see what's going on. And that's why we send this out every month. So Becky does all the updates on the stats on the spreadsheets, and then I send this out to everyone every month. So if your results are different, we need to figure out why, because they shouldn't be. And the best time of the year is coming up. This October through April is coming up. So be ready. It's coming up soon and fast. That's why you want to have any issues resolved before this month is over. Have everyone train the strategies properly before the month is over and be ready. Um, If the market pulls back and then takes off again, perfect. That's the best scenario. A pullback, then another take off to the upside. And I'm expecting a pullback actually right now, seasonally. Okay, back to the handouts. If anyone's interested in working on this with me, let me know before the week is over. I do give discounts, do after meetups. If you want to learn the daily chart strategies, option strategies. Hang on a second. Small ETFs and no open interest. Question from Bill. I noticed that some of these smaller ETFs have no open interest, two expirations out. That is true. Some of the ETFs don't have as much open interest. That becomes a business decision. Um, there's always, you can either pass, look for better opportunity, wait a week. A week from now, there might be better opportunity. That particular strike may not have a lot of open interest, but a week from now, you might be at a better price than expected and it has more open interest. 3 weeks from now, the price might have pulled back and the open interest is changing. You're at different strikes. You're getting closer to expiration, but you still have almost a month and a half left. It changes. Strikes change, price changes, open interest changes, and but yes, some of the small ETFs don't have as much open interest. Is it an issue? It can be or not. I know people literally, I watch people coaching clients. It goes against my advice, but they will put in trades where the open interest is two contracts. It's going to be the bid ask spread's going to be wide. On the way out, you're going to give up. And here's the compensation. They got in at such a better price than expected. So what? Even if they give up a little bit of money on the exit because the bid ask spread widens because of low open interest, they got in at such a better price than existed that it more than compensates for the a little bit that they might be giving up. And you don't know what the open interest will be at the time the target is hit. At the time the target is when you place the trade, open interest might have been two, but at the time that the target is reached, the open interest might be very much different at that point in time. So things change. So it's not a yes or a no. It's situationally based. If you're getting it at a much better a much better entry price than expected, then the bigger target can compensate for what you might give up with a wider bid ask spread due to low open interest. So it's not a yes or a no. It's just situational and how you feel about it. But it's more advisable to more open interest than less. No magic number, just more is better than less. All right. Like the handout here. If you want to work with me on this, um, let me know by the end of this week for the discount. I take 250 off the option pricing. The regular option pricing is the 1750 for the 6 daily chart strategies. Plus, we added two more. It's actually 8 now. So we added the squeeze play sec to sell and the squeeze play sec to buy. Those are specifically for the Qs, DIA, and SPY. There's actually 6 plus those two specialty strategies. Extremely high probability strategies. Both shorts valid, with 2 shorts valid right now, actually, which I'm actually getting someone into, and coaching clients into this afternoon after we're done here. Um, and if you want to do the future strategies, I'll take 250 off the future strategies. And if you want to do combined future and options, that's the best deal. I'll take 750 off the combined options and futures. So options here, and in the handout, you'll see the future strategy 1745. So instead of 250 off each one, it'll be 750 off um, the combination. So that's really the best deal. And what I've been finding out is I looked through my list of coaching clients, and literally everyone that is doing options is also doing futures. And everyone who's doing futures is, except for maybe one person, is also doing options. Because what people have been finding out, when one's not making you money, the other one is. So the different times that certain ones are better than others, but there's always something making you money. But literally everyone that I'm working with is kind of doing both. They're doing options and futures. They'll start with options, then months later add futures, or start with futures, then a month later add options. But once they see something is working, give it time, then they're like, this stuff's working. Let me add futures. Or they see this futures is working. Let me add options. And that's what I've been seeing with clients I've been coaching. Once you got to prove to them the methodology works, and then they want to do more because something will always be making you money. And it takes time. So what I ask people to do is commit to trading the strategies at least 3 to 6 months at a minimum. Every 3 to 6 months, we will evaluate what's working because this is how long it takes for you to see the results. You're going to go through the highs and the lows. You're going to go through bullish and bearish markets. You're going to go through a little stress. You're going to see how your P&L of your account changes. Um, because you don't you won't understand it until you're in it, and you're gonna be like, am I making any money? And but it's a business, and when we open trades and close trades, and I have to explain how that all works, and then what's it's not always blatantly obvious. So that's why I would give you 3 to 6 months of training the strategies consistently to see how the P&L changes and to really fully understand how things are working because you got to allocate time. You can't have blinders on and thinking this is going to work for you. You have to be able to see the big picture, see all the seasonal patterns, see how this is working and this news meant nothing or this is driving. And so you got to take it all in. And I do everything one-on-one, preferably I love to meet people in person when possible, but that's not always possible. So Zoom is always second best option. But I love to meet people in person. I have an in-person meeting this afternoon with a coaching client at 4:30 p.m. after the Niner game, and then because this person prefers to always meet in person, not via Zoom. And some people prefer that. I like that too, but Zoom's fine too because then we can meet at different times of day and different locations. And because it's not always convenient to meet in person because I work with people all over the U.S. and Europe, and I work with people who are in the United Arab Emirates, people in Germany, people in Europe. So I work with people all over the world doing these same strategies at different ridiculous times of day. So what you do is so I set up times as needed, just schedule whatever time with me of day or week, and we get it done. I have a pretty flexible schedule, so that's what trading did. Trading let me walk away from my 40-hour week job at Lockheed. So now I spend 50 hours a week working on 10 different things that I'm doing, but I'm always doing something somewhere, whether it's coaching a client, I teach fitness, kickboxing classes, boot camp classes. I do different things at different corporate fitness centers. Um, I'm a city official in Santa Clara. I work part-time acting and stunts, and I train in jiu-jitsu, parkour, and I just like to find. I've also become a guinea pig for research studies. I've been doing that. I think since I started in college, I was doing that. Then ended up doing that after, and I've just been doing that for so long. But I'm also a guinea pig, so I get all to see all the stuff that comes out publicly, but I get to see it first and get feedback on it. So it's kind of cool. But all those different things I do because it's fun. Not everything pays, but it's fun having time to do things. And that's what trading was able to do for me. I didn't have to rely on my 40-hour week job. Um, so I can get away and do 10 different things I enjoy doing without having to be stuck behind a desk 40 hours a week. So that was the benefit of trading for me. Let me walk away from my full-time job back in 2009. So since then, I've just been independent and open to whatever comes up. All right. Unless we have any questions, I'm going to see about ending the meetup now. And we're going to meet up again in about 2 or 3 weeks on futures. And then right after that on options again, because options this time of year is so important. So if you want to work with me, let me know right away Let's get this going right now because we're at that time where you want to be in. If you were contemplating it, now's the time. There is no better time. Now is it. And we get you going right away. So that first buy signal we get in the next month or so, that's when we want to be ready. As the market starts to pull back a little bit, perfect. And then we're looking for the next buy signal. All right, so let me know real soon. You have the handouts. My information is on the handouts on my website also. The spreadsheets are on the also on the that you saw today are in the handouts and on the website. So just go to my website and you'll find it. Otherwise, if anyone, unless anyone has a question, we're going to call it an end for the day. I'm going to watch the Niner game now and then go to my coaching client after that. And so if you don't have any questions for today, we'll see you again in 2 to 3 weeks. All right, thank you.